Sandip Sabharwal as well joins in the show. Sandip, hi, good morning. How critical do you think is this FDI policy tweak? The fact that now countries, investing into the country, sharing the borders will need prior government approval as opposed to the automatic route which was prevalent earlier.
Yeah, so I think this has been done more due to the fear mongering which went out post the small acquisition which the People's Bank of China did in HDFC. But I don't think it could. It's a very good step because of the fact that once you get into a lot of because you were in an easing cycle, you were easing out everything. So once you get into a regulatory thing where you are trying to vet each and every inflow, then I think you get into a scenario where a lot of the flows might not happen and a lot of the flows might go to other countries. So India does not have a convertible currency in any case, so it's not very easy for companies to come in, acquire and sell and take out the money, and those kind of things are not possible in India in any case. But the government has done it, it's fine. But I think where the impact will be more of this will not be on the listed space. I think it might be more on the unlisted space where many of the startups, etc., have been getting inflows from China in the form of FDI. So I think that's where the impact could be greater.
So Sandeep, I'm just trying to understand here. SoftBank and Alibaba have been large investors in the Indian startup space. What we need right now is capital, and we need recognition that look, India has got great businesses, there is a problem in the world, asset prices have come down, long-term investors are ready to invest in it. Now whether it's originated from China or whether it's originated from Hong Kong, frankly that does not matter. Right now what you need is capital, you need a long-term investor, and you also need some degree of reassurance that Indian assets currently are valuable. Why would anybody try to clog a route of liquidity? I'm just trying to understand here.
Yeah, so I think what's happening now is that the government is becoming very reactive on issues instead of being proactive. Like on the COVID crisis, they have been proactive, but on other things, they are becoming reactive. For example, they opened up e-commerce deliveries. Then, because the opposition obviously came out, criticized, and there was some news flow on how the Kirana shop should be protected, etc., they immediately came out with a notification that only essentials will be required. Then this entire noise around, I think this has happened just because of the noise around this 0.2% acquisition in HDFC. Chinese cannot take over HDFC in any case. And a lot of the board of directors, a lot of the managements are still appointed after approval from various regulatory authorities. So in India, again, I'll make out that point, we don't have capital account convertibility. And since we don't have that, it's not very easy for companies to come and acquire companies in India. And even if they end up acquiring something, it's not very easy to sell and take out the money. So I would agree with you that right now capital flow should not have been restricted. What they could have done is possibly put restriction on controlling stakes, that beyond, let's say, a controlling stake, you cannot acquire without prior government permission. So that would have worked out very well, because minority stakes in any case does not impact the overall ownership structure or the way the company operates.
Big gainers, Sandeep, for the week gone by. It was IT, it was a combination of pharma. Let's pick it up from TCS, Sandeep. I liked what they're saying, that look, we are reasonably confident by the end of this year, which is Q3, we should be limping back to normalcy. I was personally of the view that the workforce will take a damage and on-site offshore model would actually get damaged. So should one take heart from the fact that TCS, which is India's largest IT company, they managed to reinvent themselves, and on the supply side, which is manpower, at least things are protected, and on the demand side, this is not GFC that the demand will get destroyed. Does IT, which has been a mild outperformer to a mild market performer, becomes a serious outperformer because the rupee is looking okay, the manpower challenges large companies have managed to sort out, and the commentary from something like TCS is actually not bad?
Yeah, I would agree that the management commentary was not so bad, but I would think that visibility for anyone, leave aside TCS at this stage, is very, very limited. I would still think that there would be a serious damage to demand for IT outsourcing, especially for projects which are non-essential, and also for new projects which would come up. Some of the old projects which are ongoing could still continue. So the way I would look at it is that most of these IT stocks are still just 15 odd percent away from the highs, or maybe 20% high, whereas a lot of the other sectors have taken a big beating. And when I looked at analyst expectations, most of the analysts are still expecting a flat top line for TCS for this year. I would think that there should be at least a single digit decline, high single digit decline for most IT companies for this year. So I think vis-a-vis what analysts are expecting, the performance should be worse than what is being expected right now. So I wouldn't be so gung-ho on IT. The other way you can look at it is that vis-a-vis the demand destruction for many other industries, will IT have a lesser demand destruction? That is possible, and that could lead to relative outperformance.
Sure. HDFC Bank, that's also going to be in focus. While their NIMs have actually improved, slippages are at a 10-quarter low, but I think it's all about the kind of provisions that they've made, which just gives you that little bit of warning signal as to what is it that they're apprehending is in store for them and what's to come really. Do you think, Sandip, it's going to be about the earnings and the commentary, or do you think it's all about those 3 CEO candidate names which they've submitted to the RBI?
I think I became cautious on HDFC Bank early January because my view was that they have a high unsecured book right now because of the way they expanded the unsecured book, and there's a CEO change which is happening. So the stock did correct substantially. But now I'm of the view, and especially after this COVID crisis and what has happened to the deposit outflows from Yes Bank, IndusInd Bank, etc., that now it is a time where large banks and very large NBFCs have the market, where I think investors should just be owning these. Smaller banks and smaller NBFCs have become value traps. Many of them could go at least for shareholders, could go the way infrastructure stocks, smaller infrastructure stocks went after over the last few years. So I think people need to stick to quality. The franchise which gets in CASA and that's where HDFC Bank is scoring. I think ICICI, Kotak, SBI, even possibly Axis will benefit on that, where people prefer to keep money with these banks rather than any other bank, given what happened to Yes Bank, PMC, etc. So I think that's where we need to stick. The HDFC Bank did a very detailed conference call where they explained a lot of things quite well. So I would think that HDFC Bank should be an outperformer. I think they could stand out. They have taken provisions upfront, taking into account their assessment of possible NPAs. Maybe it could be worse than this if the lockdown continues for some more time. But on an overall basis, they are well positioned.
Yeah, that's a thumbs up regardless coming in for HDFC Bank. The SGX Nifty flat currently at 9,300 levels. Though it has to be said that it's recovered just that smidge. It's trying to bob ahead into the green as we speak right now. The Adani Group, though, is also going to be in focus. Pankaj owns in details on the fact that the group companies have cut the promoter pledge. Pankaj, walk us through the details.
It's quite an interesting one, when we just talk about the Adani group of stocks on Saturday, that's 18th, they made a disclosure that Adani Ports has released their pledge shares further. Even Adani Transmission and some of the other Adani group companies is what, one has gone ahead and seen that, they have reduced their pledge position. Now, this comes in on the back of after a big reduction, what they did on April 10th as well. So you put both of this together, close to about 8 to 9,000 crores in terms of absolute value is the sort of stocks that they have actually gone ahead with. Just to give you an example, Adani Ports peak pledge promoter holding was about 60% of their holding, which has now come down to less than about 40%. In fact, closer to 30% is where that holding is. So all of these stocks will be in focus, whether you talk about Adani Ports, Adani Transmission. Second tranche of pledge coming down to reduce. Overall, if I look at their promoter holding across countries, across companies, Adani Ports, of course, by market cap is by far the biggest, but even some of the other ones are now close to between 30 to 40% versus about 60% what used to be the peak earlier. So all these Adani stocks will be in focus. Promoters have gone ahead for the second tranche and come out and reduce their pledge holdings. The disclosure of this came in on Saturday.
Thank you for that, Pankaj. Okay, Sandip Sabharwal also with us, of course. We've been in conversation with him. Sandip, I also want to talk about TVS this morning, of course, in the news, for the acquisition of Norton's. I find it really interesting because while Norton strategically puts it in the same bracket, or allows it to tap into that market, which would normally go for Royal Enfield, at a time like this, when we've anyway been discussing the growth for the sector, it's an interesting buy. What are you making of it? Is this something that could realistically change the course or the trajectory for the stock going forward?
Not in terms of the trajectory for the stock in the near term, because it's a small acquisition. Whatever they want to do with this acquisition, it will take some time for it to play out. In the near term, I think these stocks have to react more in terms of what the domestic market is doing when the market opens up, etc. So I think whenever we get some inkling of an opening up of the economy, two-wheeler stocks should start performing from there, because I think in terms of demand revival in the auto sector, two-wheelers will lead the charge.
Something to watch out for there. Also, let's talk about Kotak Mahindra Bank, because last week we were discussing several of these names, and Kotak in particular was definitely seeing some pressure. They're going to consider raising equity capital. That's coming up on the 22nd. Possibly fears of further correction. We're already seeing the Uday Kotak stake reduction, and of course, all those concerns looming large on the NPA and credit growth slowdown given the lockdown. What are you making of this attempt to raise funds, Sandip?
I think it could be a part, I guess, of the promoter stake reduction which has to take place. And on top of that, all of us know that Kotak has traditionally been a very conservative bank. So they could be taking a stance that if we are in for some tough times for the economy, it's better to be more capitalized and rather than being less capitalized. And they would have taken this step of calling in for the board meeting only after having some dipstick survey of potential investors who could come into the bank. So I would think that it should be a good move. And they should, if you actually see what they have done to their deposit rates also, they have cut down savings bank deposit rates very sharply overhand. And that just shows that Kotak also has been getting a lot of deposits which are moving out from smaller banks. And to that extent, they don't need to give the kind of rates which they used to give earlier on their saving bank deposits, which actually is very accretive for their margins. So I would think overall Kotak Bank is pretty well placed. And if this fundraising move leads to a correction in the stock, then I think we should look at buying rather than being concerned.
Sure. Sandeep, how concerned are you about the fact that FIIs have turned net sellers again, and by huge quantums in the last 3 trading sessions, after having net inflow of roughly about 1,500 odd crore rupees month to date in April?
I think that is something we could actually see, because see, finally the markets have bounced back 20% plus from the bottoms. Eventually, my view is that markets cannot move up in such a straight line for a very long period of time because the economic damage both in India and globally is real. Right now, markets are reacting to a lot of the stimulus measures of the central banks as well as the governments. But eventually, the markets need to give up some of the gains which they have taken out, and that and if as that happens and as we come more closer to what could potentially be the end of the lockdown, which we don't know whether it will be 3rd May or not, that would be the time to actually buy more. So I would think that in terms of what we call a trading range, we are reaching more near on the upper boundary for the short run at least, rather than there being a chance of a significant upside.
Okay, Sandeep, cement was emerging as a theme yesterday, at least on the charts. We're also looking at, construction activity being eased, of course, as we move ahead, in this lockdown. Is that a theme that you're looking at as well?
In cement, we do own India Cement and Ultratech Cement. I was constructed on cement, so we haven't actually exited cement in the downturn. But what we all need to realize is that even when the activity is coming back, it is going to be a very small proportion of the activity which was there prior to the lockdown. So the demand destruction is going to be very, very significant. And that's something which many of the people are not realizing today. Even if you see the pharma sector where there's been a huge run up in stock prices, if you actually see most of the pharma companies are still saying they are operating at 20-25% of capacity. So I think the markets are reacting to news as on the negative side, they were overreacting. I think there's some overreaction on the positive side, at least for the very short run. So markets need to consolidate their gains, give up some gains. Otherwise, it becomes riskier if the market keeps on rallying the way it has been.
Let's just quickly take stock of what the pre-open rates are like and what is the move coming in on HDFC Bank. I guess that's going to be the single-handed critical mover in trade today, and would be interesting to see how the street really absorbs those numbers. On the pre-open rates, while the SGX Nifty was indicating a quiet start for us, look out for HDFC Bank and then Infosys as well, which delivers its numbers. You've got some of the other numbers as well, Nifty names which are slated to come out with their numbers just this week. ICICI Pru being the other one, wherein the commentary is going to be extremely critical as well. I also want to look at for what some of the other names like TVS Motors, for instance, is doing. They've acquired one of the British companies. ACC has resumed operations in a phased manner, so look out for some of those names as well. JK Cement, we're going to be chatting with the management too later in the day, and they have partially resumed operations in the states of Karnataka as well as Uttar Pradesh. So some of these stocks are bound to react to the news flow coming in. But Sandeep, what a move coming in on both Motherson Sumi as well as Bharat Forge in the week gone by. Renewed optimism that it's going to be a big no-no to shared mobility. Some of these companies indicating in the interactions as well that their order flows are looking very strong and they're booked for the next 5 to 10 years. Do you think this optimism is justified, and would you be a buyer in any of the auto ancillary names?
I think auto ancillaries also could look good as we come nearer to the end of the lockdown. But I think in some of these companies, optimism could be over-optimism. For example, Motherson Sumi has such a hugely leveraged balance sheet, and it has such a big presence in overseas markets that many of these markets will take a long time to come back. And they did declare some numbers on leverage and how it's come down. I find it very difficult to believe that in a quarter where actually demand totally collapsed, how they came out down, how did the leverage actually come down? Bharat Forge, on the other hand, is a somewhat different story, but many of their user industries also where they were looking for big growth like aerospace, etc., will take a hit. Autos have obviously taken a hit, but then stocks get beaten down so much. Like if I remember rightly, peak of Bharat Forge was 800. It got beaten down to 220, 230. So obviously there's value which comes in because it's finally a debt-free company. So I think what people should be looking at is where there's less leverage and where there could be some benefits. So Bharat Forge and Motherson Sumi are in different categories. If at all someone has to take some bet, Bharat Forge could be better, but there also in the near term visibility will be very, very low.
The iShares stock